Welcome to my new channel on investing. I spent most of my career at large institutions picking stocks using a quantitative framework, and my goal here is to share some useful insights with you. So, if you had to pick just one stock out of thousands, how would you do it? Flip a coin? Go with a tip? Hedge funds and other quant managers don't guess. They use data-driven models, and they do it systematically. In this video, I'll walk you through the approach that many professionals use to rank and select investments, whether it's stocks, bonds, or ETFs, using a simple scoring model based on core characteristics. I'll show you how to apply the same logic to your own portfolio, introduce the concept of portfolio optimization, and point you to a few great resources if you want to go deeper. So what makes one stock outperform another? It's the holy grail of investing, a question people have been trying to answer for as long as markets have existed. Well, you may remember from your statistics class the concept of explanatory or independent variables. Applied to investing, these are the characteristics of stocks that have historically explained the differences in their returns. In quant speak, we call these signals factors. This approach is known as factor investing. The tool used to analyze them is called regression analysis, and it's incredibly powerful in finance. Beyond individual stocks, you can use it to figure out what's really driving a fund manager's performance and whether there's any true skill left after adjusting for risk. We'll dig into that in a future episode. The investment industry has identified many of these factors through research and has built them into their models. Let's walk through a few of the most common ones. First, valuation, the cornerstone of Warren Buffett's philosophy. It's one of the most time-tested predictors of long-term returns, but it can fall out of favor, and value stocks can underperform for months or even years at a time. Next, earnings outlook, which reflects short-term investor sentiment. This factor looks at whether analysts have revised their forecasts up or down, by how much, and how recent earnings compared to expectations. Its performance depends a lot on how the signal is constructed and how quickly you can act on new data. Then there's financial quality, which captures a company's overall financial health. It's typically measured using leverage ratios like debt to equity, and the gap between earnings and cash flow, which can help flag potential accounting risks. This factor tends to be more stable in performance. And finally, price momentum, often defined as the stock's return over the past 6 to 12 months. Momentum is powerful, but volatile. It often clusters by sector, and it's prone to sharp reversals. We saw that with the surge of AI stocks in 2023 and 2024, followed by their whipsaw returns earlier this year. In the quant space, researchers have uncovered dozens of other signals, things like insider trading activity, patent filings, short interest, and even social media sentiment. The catch? Many of these rely on expensive or hard-to-access data. For example, some data vendors track parking lot traffic at big box retailers like Walmart and Target, then use that information to predict company earnings or even gauge the health of the entire retail sector. By the way, if you're wondering where all this research comes from, there's actually a free academic database called SSRN, where a lot of these factor studies are published. I'll walk you through how to use it at the end of the video, and I'm happy to do more videos to explore other, less well-known factors, so hit that subscribe button below to get notified. Let's do a walkthrough using a basic example. Say we're only interested in the top 5 largest Nasaq stocks, and we want to rank them in order of their desirability as an investment. For this exercise, we'll only consider value and momentum, since sourcing the data that goes into these two factors will be fairly straightforward to demonstrate. In reality, you'll probably want more factors in your model to provide diversification, just like how you diversify with stocks. Later on, I'll explain why I choose to use these large tech stocks in this example. First, let's define what we actually mean by each factor. For value, I used a metric called forward price to earnings. It tells us how many dollars investors are willing to pay today for each expected dollar of earnings over the next year. I pulled this number for each of the 5 stocks from Yahoo Finance. For momentum, I used the most common definition, which is the stock's total return over the past 12 months. In practice, you'd typically exclude the most recent month's return, since research shows there's often a short-term reversal effect at that 1-month mark. But to keep things simple, we won't get into that level of detail here. So now we've got our raw numbers for value and momentum. Next, we need to scale these raw numbers so they contribute equally to the scoring system. Right now, Value and momentum aren't even measured in the same units, so we can't compare them directly. One simple way to fix that is by ranking each stock from 1 to 5 on each factor. For value, a rank of 5 means the most attractive or the best value. We'll do the same for momentum. 5 means the strongest performance. Once we've ranked the factors, we simply average the value and momentum scores to get what's called an alpha score. This gives us a rough estimate of which stocks have the strongest upside potential based on their underlying characteristics and using a simple systematic model. There are more advanced ways to combine factors, but here we're using the basic approach of equal weighting. And once you've calculated those alpha scores, there are a few different ways you can use them. Option A, the simplest approach, is to pick the top stocks based on their alpha scores and invest in them equally. In our example, that might mean 50% in Apple and 50% in Meta, since they both scored the highest alpha of 4.5. Option B, which is a bit smarter, uses the scores as portfolio weights. For instance, Apple and Meta might get 28%, Nvidia 22%, and so on, all based on their alpha scores relative to each other. This approach also gives you more diversification, because you're spreading your investment across more names. Option C, which is more advanced, combines the alpha scores with each stock's volatility and the correlations between every pair. This lets you build a portfolio that balances expected return with risk, and that's what hedge funds do. This process is called mean variance optimization. It doesn't just look at which stocks have the highest expected returns. It finds the best mix. Your optimal portfolio depends not only on return expectations, but also on each stock's volatility, their correlations, and how much risk you're willing to take. This trade-off is captured by something called the utility function. And why do correlations matter? Because when stocks don't move in sync, you get diversification, the magic word in investing. You can use the solver add-in in Excel or free tools like Portfolio Visualizer to run this kind of optimization yourself and target what's known as the efficient frontier. In future videos, I'll walk through an example step by step, so make sure to hit subscribe if you want to follow along. So why do hedge funds like George Soros or Ray Dalio have an edge over individual investors like you? Well, the model I just shared, while it reflects real techniques, is still a simplified version compared to the level of sophistication and resources that institutional asset managers have. Let's break down some of those advantages. First, your quant model is only as good as the data you feed into it. As they say, garbage in, garbage out. For simple inputs like price momentum, it's harder to go wrong. But with more complex accounting variables or niche signals, data quality becomes a real concern. You also have to watch out for biases in your historical datasets like survivorship bias or look-ahead bias, especially when running backtests. These can make a weak strategy look better than it really is. And beyond cleaning the data, you may need to adjust it for fair comparisons. That's why, in our simple example, I used 5 large-cap tech stocks. Comparing metrics like price to earnings across very different sectors, such as tech versus utilities, can distort your signals. The context matters. Second, just because a factor performed well in the past doesn't mean it will continue to do so. Take momentum, for example. It might work great for years, then suddenly reverse. That's why professional money managers have to constantly adapt. A good example is the Quant crisis from 2018 to 2020, when many quant funds were heavily concentrated in a few large growth stocks. That crowding led to collective underperformance. Hedge funds, of course, have far greater resources, and not just to clean raw data, but to research how factor performance shifts over time. They have the personnel and systems to do it at scale. Let's also talk about transaction costs, something that's easy to overlook. In practice, the net return from any factor or alpha score gets reduced once you account for the cost of trading. For small investors trading large cap stocks, this impact is usually minimal, but if you're managing more money or trading in microcaps or illiquid names, those costs add up fast. In fact, they can wipe out your entire edge, turning a seemingly profitable strategy into a losing one. So what can you take away from all this? Even though we can't replicate a hedge fund's infrastructure, we can borrow their mindset. Use data, rank stocks, stay systematic, and not emotional. Don't chase tips, and always consider risk and diversification. Doing just that already puts you ahead of most investors. I'll be sharing more videos like this soon, including a walkthrough of how to backtest simple models using free tools. So stay tuned. Finally, I want to highlight a public resource called the Social Science Research Network, or SSRN, which is completely free to access. And just to be clear, this isn't a sponsored segment. I don't get anything out of mentioning it. I'm just a fan of the platform and think it's a great tool if you want to go deeper. SSRN hosts a massive collection of academic research papers. Many of them are written by finance professors, PhD students, and industry practitioners. If you search for something like factor investing, you'll find dozens of studies on different strategies. The writing can be dense, but even a quick skim usually gives you a sense of what factor was tested and whether the results held up in back tests. Thanks for watching episode number 5 of Money in the Markets. I'm about a month into this new channel, and if this video helped you think more clearly about stock picking, hit that subscribe button. I'll be diving deeper into portfolio strategies, backtesting tools, optimization techniques, and quant methods to evaluate fund performance in upcoming videos. Subscribing also helps me keep making more of these in the future. Click on one of the mini windows to check out another video on investing, and let me know in the comments what you'd like me to break down next. See you next time.